Hey, Franchise Secrets, part 2 of Is My Business Franchisable? This is amazing information. We got through number 10 on this episode. Number 8, Jeff just started spitting gold. Like, there are things that you need to understand from a financial standpoint for both you as a franchisor, and one of them was understanding franchisees' profitability. I think franchisees, you'll find this really interesting. Anybody that's buying a franchise should listen to this because it really helps set the stage of what franchisors should have in place for you as a buyer. So I hope you enjoy the episode.
Representing Franchise Secrets, Erik Van Horn.
Hey, Jeff, welcome back for episode 2 of what do I need to do if I'm going to start a franchise organization? Some people tell me I've got a business that's franchisable. Now what? And that's usually when you and I get the phone call. Most of the time, we're talking people out of it. And so we figured we'd give the audience a bunch of information, like kind of the 10 questions that we normally hit on when we're talking to people that are thinking about franchising their business. I think this is also helpful to people that are buying a franchise. Make sure that your franchisor has these things thought out, and then if you're a franchisee, hopefully your brand is doing well with all of these things and ask themselves these questions before they started. We got through the first 4. We're going to hit number 5, which is scalability. And when I think about that, I think franchisors should be thinking, do I want single unit operators or owner operators or multi-unit operators? And I just spent a day in Atlanta at the Chick-fil-A offices, and it's incredible what they've built. But they have owner operators. A lot of people in food have multi-unit operators, but Chick-fil-A has single unit operators. I think their average unit volume is probably that $6 million, $7 million per location. Yeah, and I was talking to some pretty people high up there, and it's absolutely amazing. But they chose to have owner operators, which their models a little bit different. But I think it's an important question that franchisors need to think through as they start to scale this, because there's advantages and disadvantages to both. But what say you on scalability, single versus multi-unit operators?
So I think the first point is just like that example you just used with Chick-fil-A, you have to always do what's best for the brand. And, the founders of Chick-fil-A, the family, the team, they went down that path. And for that brand, it's the right path. I mean, look at their unit level performance versus the industry. And so for Chick-fil-A, without a doubt, that was the right path for the brand. There are other brands where multi-unit, it's the right play for the brand and it's the right play for the franchisee. So I think that the example that I've always heard, and I don't know the exact statistics, but I think that all of the Paneras in the United States are owned by 30 or 40 people. That's the other extreme, right? Where groups have 100, 200, 300, whatever. And that was right for that brand. So look, at the end of the day, everybody else is going to be in the middle, right? You're going to probably, just by market size alone, maybe it can only fit one territory. Maybe it can only fit one franchisee. That's going to happen. But in the markets that aren't that size, where only one can work, right? Whether it's brick and mortar or service, doesn't matter. But if the market is to a size where only one works, then of course, in those markets, you're going to have singles. In the rest of the markets, you're probably going to have a mixture of both. And the systems, from a brand, when you start to think about, okay, which direction is right for me, you have to think about supporting these franchisees. And so what are the challenges in supporting a franchisee network when 100 franchisees own 100 territories versus 100 franchisees owning 300 territories. You're supporting the franchisees. You're also supporting their territories with however many they have. What you find is that the first year of supporting an individual franchisee that's new to the system, that takes the most amount of energy. The franchisees are also going to need the brand the most in that first year because chances are everything that they're experiencing is their first time. And if you are an emerging brand going to market, right? So you're a new system inside of franchising, you're going to be learning a lot as well. And so you're going to want to make sure that you can support these franchisees, and you're going to have to level up that team that's going to support them. And so having a nice mixture, okay, of multi-unit and single is probably going to end up being the best result for most franchisors as well as franchisees. You know, when you want to build a system, you want to make sure that the franchisees that you are bringing in have the ability to build net worth with that business. And so down the road, some of these franchisees might be looking for an exit strategy. If every franchisee in your system has to be an owner-operator to succeed, it may be more difficult to sell that business. And even if you sell that business, it may not be at the price that you want, because somebody that's going to be buying that business may have to be an owner-operator as well. And they may not have territories around them that they can expand to. And so, you know, I think a lot of people that look at multi-unit say, look, I'm going to start with one. I'm going to learn this system, but I want to have the ability to grow as well so that I can build wealth. And maybe one day I want to exit. And if I have 3 or 4 territories that I've fully developed, that's some package that you want to offer to another franchisee. You might get a higher multiple on what that business is versus if you only owned one.
I think that's excellent points. I mean, take that to the bank. I think another thing that franchisors need to think about as they are considering single versus multi-unit is the franchisee that has experience owning other brands, and they come to you and be like, hey, we've been successful with brand A, B, and C. We want to do 10, 15, 20, 50 units, and we want a sweetheart deal from you. And at first, the new franchisor is flattered. Well, you know, wow, great. Now, and it's an influx of cash or capital coming into the brand. But you need to ask yourself some really important questions if you're going to bring in a big player like that. I would say 99.99% of the time, that is not going to end well. And we advise against that in most cases. You do make sure they have the capital to be able to do what they say they're going to do. And then do they have the ability to open up according to the schedule? Let's say you have, 4 that need to be open up every year, and that's the schedule. It's easy to think like, oh, I'll give them a break for whatever reason. And maybe you do, maybe you don't. And also you need to make sure that they're focused on that. How many different brands are they doing this with? And the other ones, why are they not continuing to grow with the brand that they're a part of? Maybe the franchisor is not as great as they thought it was. Maybe they're exiting it. Maybe they're not making money. Maybe they're making a ton of money and they're just wanting to diversify. There's a lot of different reasons why you may want somebody like that. Let me give an example. When I started looking in the salon suite business, it was me and a couple other guys. And they came to us and they said, yep, we'll award all of Orange County to you, but you have to open up for a year. Like, that's the development schedule. And we pushed hard on it, and they said, no, this is what it is. If you want that whole market, you need to open up for a year, one a quarter. And really, over the period of time, that was like $12 million. Each one was $1 million.
Wow.
So I looked at my checking account at that point. This was about 10 years ago. I couldn't do that myself. We could have done it with the 3 of us, but we said, if this is the development schedule, we need to bring in another partner so we can make sure that if something goes south, we have the ability to open them up. And guess what? Something went south. The banks, SBA stopped SBA backing the loan. So things went south. We financed the first 2 or 3 with SBA, and then SBA pulled out. So we had to get creative, and we did, but we had 4 of us to do it. Those were the rules. Those were the parameters. We knew what we were going into. If they hadn't given us that development schedule and threatened to like stick to it, then of course we would have, open up 1 a year or 2 a year. And we wouldn't have done, Solo wouldn't be where they are today as, multiple exits, a very good brand, but they are that today because they stuck to their development plan. So I think that's something else that you need to look at when you're thinking single versus multi-unit, and for the most part, stick to that development plan for new franchisees.
That's right. And guess what? The decision that they made to say, hey, let's make sure that this development schedule is quick, and you guys better know that you have to adhere to this. That was the right decision for the brand. And guess what? That ended up being the right decision for you guys as well.
Attention, franchisors and franchisees. There are 2 really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisee and you want to be around a community of successful Zs and other brands and in other industries, this is why I created the Franchisee Mastermind. If you want access to the best single and multi-unit owners to know what they're doing, or if you want to be around other multi-brand owners, then you'll want to check out my Franchisee Mastermind. The reason why people join is they want access to my Rolodex, my connections, to each other. They want a shortcut success, both short-term and long-term. Links will be in the show notes or at scalablefranchise.com. Yep, it did. And they were helping us do that. All of a sudden, SBA dried up. They knew they needed to find financing elsewhere, and they did. So it's not just like, okay, now it's on you guys as franchisees. And I was like, they came in and helped. So that's where a good franchisor will absolutely do that. All right, number 6, profitability for franchisees. Is my brand have the ability for franchisees to be profitable? Hopefully highly profitable. So, when we're talking to these different mom and pop businesses that are thinking about franchising and we get into profitability, Jeff, like what are some of the things that they should be asking themselves with that question?
So the first thing they have to do is they have to take a look at their existing business that they are looking to franchise, and they have to look at the unit economics on that business. I think that sometimes when they look at it and they're like, okay, the unit economics of my corporate business is really strong and compelling, right? They might be seeing like, there are some service-based industries out there where the revenue could be high. Maybe the margins are a little bit lower, but maybe they have a business that's doing $2 or $3 million and their net margins today are 15%. For that type of business, that's pretty good margins. But when they start to think about, okay, when I look at sharing my unit economics in an item 19, right, and showing financial performance, they're going to need to add something. They're going to have to impute some numbers that they maybe don't see on their own P&Ls, right? Because if you're showcasing this opportunity, hey, look, I've got a business doing $3 million, and last year my EBITDA was $450,000. 15% sounds pretty attractive. But as you impute royalties, 6, 7, 8%, or brand fund, 1, 2%, and technology fees or anything else, a lot of times the franchisor fees, when you look at royalty and brand fund and other items, they might be around 10%, maybe even 12%. So now all of a sudden, when you look at that corporate business, that it looks really, really good. Once you start imputing some of these fees on the franchise side, if that number pulls down under 5%, that might not be as attractive. So you have to start thinking about, if you're going to marketing, you're looking at your corporate stores, can I add the right support structure and fees that come with that and still provide a high level of probability for profit margins for my franchisees? Because once again, if franchisees are profitable, they're going to reinvest into opening up additional locations very quickly, right? So that's really important to understand on the profitability piece. The next thing is sometimes we talk to some brands that have been doing this for 10 plus years, right? And they now have a business that's highly profitable and they are ready to take it to market. Well, if a franchisee is coming in, one of the things they're going to want to understand is what do I need to do to be successful to ramp the business fast, right? I want to get to break even quickly. I'd like to get to cash flow quickly. If it took your business 10 years to get there, you have to have a plan to show the franchisees how to shrink that time frame, right? Now, chances are your business that maybe grew over 5 to 10 years, you've figured so many things out. So the tools that you're utilizing today, if you would have had them back then 10 years ago, probably would have gotten there quicker. But if some franchisees coming on board and they're looking at, okay, here's my initial investment, here's my franchise fee, here's what it's going to take for equipment, or if there's a build out because it's brick and mortar, it's all that stuff. But the big ticket item is going to be that working capital, right? How much working capital am I going to need to get the business to be cash flowing? And I would say that most franchisees, they want that number to be 6 months or fewer in most cases. And so does your business, do your processes and systems and tools today allow franchisees to get to cash flow positivity within 6 months? Can they get there quicker? The faster, the better. But one thing they're not going to do is sign a 10-year franchise agreement and say, okay, I'm just going to go and grind it out for 10 years like you did to finally get to that spot, because they're looking for a return on their investment. And I would say that most franchisees are trying to say, okay, if I invest all this capital up front for this unit, for this territory, for this business, I would like to see if I can potentially earn that investment back within 3 years or less. That's kind of a marker. If it's going to take 5, might be tougher to get franchisees. If it's going to be less than 3 years, that's fantastic. But I think that those are the things you want to think about. Can I be cash flow positive within 6 months? And even during that 6 months, can I decrease the amount of cash I need each month, right? Can I accelerate through that? Is there a pathway for me to get a return on my investment within 3 years? Do you have the tools today in your business that will allow franchisees to ramp the business a heck of a lot faster than you did? So that's the way I look at it.
I think also something to consider is when your franchisees you want them to, let's say it's 4 units or trucks or whatever it is, you want them to open those up for a year. If the financials don't look good to a bank, the bank's not going to finance their next location or their next truck or whatever that looks like. So it's not just them, but if they're using banks, traditional banks, that's something that they're going to look at. I think we need to be thinking, how quickly can they be cash flowing? And as a franchisor, look at that item 7 and don't look at it through the lens of a small local mom and pop or regional business. Think about that nationwide, something that's scaling across the country. A lot of brands, when they start out, especially in fitness or any type like beauty or brick and mortar brands, they have the most beautiful build out, and founders think that's their brand, high end this, expensive that. But when you start to scale that across the country, and you want franchisees to open up at break even or close to break even or break even from a cash flow standpoint within 6 months, you might want to look at how can I achieve the same look and feel, but without importing rugs from Italy or equipment from this area or, just anything with the FF&E. So I would be looking at that. And
value
then
engineer.
Yeah, you've got to value engineer that. Marketing, you probably want to front load as if you're just scaling slowly, you may be okay with using some of the referrals or brand recognition in your other locations in that region or in that same city. But if you don't have any brand recognition, you probably want to spend more money initially for marketing. So that's got to be considered in that item 7. And then here's what a great one looks like. And I was just on the phone this morning with some of my business partners in a franchise brand. As a franchisee, I'm an investor in this at the franchisee level, and we're getting ready to open up our first location, meaning grand openings happening in October of 2024. We are scheduled to have $15,000 per month profit in this brand and at this location. Now, not all of our locations are going to do that. Some are not looking nearly as good. Open up maybe $2,000 a month, cash flow positive. That is great if you can start to get to that point. I'm sure early on in that brand, that was not possible early on when that brand was just starting out. But it makes me and my partners want to open up more faster because we are cash flowing right away and consistently. So if you think about how can my franchisees open up at not losing as much money from a cash flow standpoint or actually making money, cash flowing, it will motivate them to open up more faster. And that's what you really want if you're going that multi-unit route. So any last comments on that, Jeff, before I move to number 7?
No, let's rock.
Number 7, how strong is my support and training? And maybe you don't have it yet. So are you ready to invest into it? Like, am I ready to invest in strong support and training? Do you even know what that looks like? So I think you need to understand what strong support and training looks like. And are you really ready to invest human resources, your brain trust as the founder, and then, capital to have amazing support and training? And that's that's pre-training, training, ongoing training, all kinds of different things that support and training fall into. But what would you say to someone that is thinking about starting a franchise and they're like, I don't know how strong my support and training is? So what would you say to that person?
So I think we kind of talked about this in one of the earlier questions. One of the things that you and I talk to founders about when we're learning about their business and wondering whether or not this would be a good fit for us to partner with is from whatever you're selling, you're either selling a product or you're selling a service. How complicated is it? How complicated is it to deliver? Not just once, but consistently perfect every single time. If you got 100 franchisees and 50 of them are always getting 5 stars and 50 of them are only getting 3 stars, that's not a winning solution, right? You have to make sure that your franchisees can deliver a product or service that is going to garner a 5-star review every single time consistently. Okay? So that's where you got to start is do I have the assets and tools for my franchisees to earn a 5-star review every single time they sell the product or service? And that's the first box that has to be checked. Okay. The next thing is that whether it is simple or difficult to provide this product or service consistently, you still have to have the assets. What I see most brands doing today is they create a training portal of some sort, right? We talk about learning management systems, right? LMS software that can contain training and education and brand assets and really kind of becomes the central nervous system of the brand, right? If you don't want to invest into an LMS, you still have to have some kind of centralized portal, platform, asset for franchisees to tap into. Your operating manual is never going to be done. It is going to be a living and live document that is constantly updated, constantly refreshed, constantly improved. So you're not going to be sending out paper copies of like an operating manual to franchisees. It's going to have to be electronic. It's going to have to be in real time. It's going to have to be updated, right? So do you have these assets? What I see most franchisors do today is they have four types of training. The first is what happens when they sign their franchise agreement. There has to be, in my opinion, online tools of training, pre-training is what most people would call it, before they actually come to corporate for training, right? So stage one, step one, the first part of training is pre-training materials that they can engage with so that when they actually do come to corporate training, they're more prepared, right? Versus starting from scratch. Because when they come to you for corporate training, that's typically anywhere from 2 to 5 days. So you want to be able to accomplish as much as you can with this pre-training before they actually come there so that that time spent at corporate is highly efficient, right? And a little bit more advanced than having to start from scratch. The second type of training is that corporate training. 2 days, 5 days, 2 weeks, whatever it is, right? Time engaged with your training and education staff, your leadership team on what it's going to take to operate this business and knock it out of the park, right? And that is going to have its own curriculum, right? That's going to have its own set of training materials and tools. And you know, there's the good news is if you look at what I would do is look at other FDDs in your category with like-minded businesses. Everybody has to put in what type of training they offer their franchisees, okay? And they're not going to give you their training manuals, but they are required to list out the glossary, right? The days of training, what are you going to cover during those days? How many hours are included in those days? So if you want to get an idea of what you have to supply in terms of, you know, corporate training, just take a look at FDDs of like-minded brands in your category and you can see what the other guys are doing, right? Do you want to provide less than that? Probably not. Do you want to provide more than that? Maybe, right? But at least if you want to get your hand around like what other people are doing at that corporate training, then that's a good place to start. So we just talked about pre-training. We just talked about corporate training. Most franchisors then are going to have on-site training, right? After you leave corporate and you go back and you start hiring your employees and training your employees, once again, it's all about consistency, consistently being able to deliver a 5-star experience every single time. And so the third level of training is when the franchisor has individuals that come out to you. And that could be for your grand opening. That could be for a couple of days. That could be for a week or 2 weeks or whatever it is. They're going to charge you for that, right? There's usually a charge for on-site training, right? Whether that's a static fee, right? Like a lump sum fee, or it's an hourly fee. But that's the third piece, right? So you have the pre-training, you have the corporate training, then you have on-site training. And then the fourth one, which is probably the most important, right? Because those 3 sets of training are usually all within 3 months, 6 months, 9 months, 12 months max, right? The fourth one is the continuing education. As a franchisor, you're going to constantly bring out new and improved tools, new and improved technology, new and improved platforms. And you have to make sure that you can train on these new tools, train on these new platforms. And so your LMS is constantly going to be fed with, we are rolling this out, right? We beta tested this strategy. We beta tested this marketing. We beta tested this new way of making the product or the new way of delivering the service. There's going to be continuing education. So it's not just about, you know, training is not just about people coming to you for a few days anymore. It's pre-training, it's corporate training, it's on-site training, and then it's continuing education and training in perpetuity.
When I started my first franchise as a franchisor, we had pre-training, and we did pretty good. We did pretty good at pre-training. And then we had our real training, our first in-person training with our very first franchisees. And the four of us founders sat through the whole training. We did some training. We had trainers in there. We sat through the whole thing taking notes. And we left with a pile of things that we need to fix. We also asked the franchisees who sat through the first training that we ever did for feedback. And it was brutal. We asked for feedback and we wanted it, but as our list was long, their list was long. Their list was right. They had things in there that were like, ooh, we didn't think about this because I'm not in their shoes. I thought about it from a different perspective. And so we immediately, like real time, started to change training. And one of the feedback, some of the feedback they gave us was, you need to shift this day of training into pre-training and change the schedule of training, because we knew we were drinking from a fire hose, but it was just way too much. And so we needed to change the training, how we did things, and allow for more breaks and all kinds of different things. So we didn't go into it with a mindset of like, with the industry expert, with the franchising experts, we know how to train. We've done this before. No, we went in like, they're right. And we changed things. It was continually changing. So I think you need to be open to your franchisees to have feedback on all of those 4 trainings that Jeff just spoke about. Get feedback from your franchisees. Not that you're going to implement everything, but if there's a real-time feedback loop, that's how you're able to change things and make things better, because they're seeing it from a different perspective. Even challenging or maybe high maintenance franchisees, more granular or nitpicky, they might actually, have things for you to be able to implement and to change for others that are more detailed and just make training better in general. So I just think of, as long as you have that feedback loop that's real time, and you have a culture of how do we learn and how do we change things. And with that, you're not going to change everything. You can't take everything a franchisee says, because different franchisees are going to want different things. But if you get consistent feedback on certain things, you might want to look at changing some of that. So that's support and training. Anything else to add before we go to number 8?
No, I think that's good, man. I think that's good. Yeah.
Do I feel comfortable with like the financial and legal considerations? There's a financial cost to being a franchisor, and it's easy to underestimate that, and just initially and then ongoing. And the same with the legal aspects of it. Like, you need to get a franchise disclosure document, the FDD, but there's a difference between having a generic FDD that is just kind of, fill in the blank FDD, and having an FDD that is well thought through with somebody that knows franchising inside and out. Besides just an attorney, the attorneys are great, and I would recommend having a killer attorney that has done a lot of FDDs, help you with your FDD, but also have somebody that has been through it and really been through an exit. So starting one to exiting one, that's where, Jeff has an amazing amount of experience on the Front Street founder team to be able to help our brands think through things that's not even on their radar when they form that initial FDD. So what kind of comments would you have, Jeff, on the financial and legal considerations before becoming a franchisor?
Yeah. So part of what you're talking about is what we call like go to market, right? So there's certain things that you must have in order to even go to market as a franchisor. And that first piece is legal. And that's going to be a piece that needs to be arm's length, meaning like, even if you're an attorney, you don't want to write your own FDD, right? You need a third party to create that document. And I've probably read through 1,000 or more of these, and some are very good and some of them are very bad. And look, at the end of the day, that's life, right? Everything is on a spectrum. There is a cost associated with that. I would probably say that like drafting not only the FDD, but the franchise agreement. Some attorneys might charge extra if you want, an area representative agreement folded in there. They might even charge extra for an item 19, right? But there's a considerable amount of time that is necessary. Attorneys charge by the hour. Some might give you a flat fee actually for the document, but maybe that's only for a certain amount of hours. So you definitely want to have your ducks in a row even before you go to an attorney. They're going to send you a document anyways. It's kind of like all your pre-work. Hey, these are all the things that we're going to need to get from you in order to draft this. But look, it's going to be on the low end, 10,000, probably more realistic to be in the 15 to 25 range, right? For quality work. You get what you pay for in most cases, but that's a hard cost item.
And Jeff, there are even attorneys or people that outsource it to attorneys that will charge that much for not a very good product. So
yeah, look, you get what you pay for. Yeah, look, you want, look, this is a document that is going to determine, the strength of your system and how you can protect it. It's meant to be a one-sided agreement because you have to protect the brand. This isn't meant to be like, harm franchisees, but it's definitely meant to protect the brand. And so you want to work with, franchise attorneys or law firms that are experienced in this category. They've seen a lot of things that happen after brands go to market. And this document needs to protect that brand. It's all about loss mitigation. We talk about that a lot. So there's a hard cost to legal, right?
Yeah. And right now, I'm going to give a quick, hold your thought there. I want to give a shout out to Lane Fisher over at Fisher Zucker. He puts on a conference once a year called Springboard. And I think that is something that franchisors that are thinking about getting into becoming a franchisor, entrepreneurs thinking about becoming a franchisor, that's something to put on your radar. And you can talk to him there and other franchisors that have used different attorneys or different groups to help them to see, the quality of work and why they may have shifted from one to another and whatnot. So I wanted to give a little bit of helpful advice there, but Springboard in Philadelphia, they do it every year in September. So Jeff, continue on.
So there's a hard cost just associated with putting that document together, that list of documents together. And that's going to get you good to go in 30 states. The other 20 states are going to have additional cost if you want to go into them, if you want to be a franchisor and market your franchise opportunity in those states. And some of those states are the most populous states, like in New York or California, right? Or in Illinois, right? Some of the biggest cities in the country that you may want to go into are in some of these registration states. These business opportunity states, those registration states. But there's 20 states out there, and a lot of them are pretty important, that you are going to require an additional cost of filing and renewing and or registering in those states. And if you want to go into all 20 of those, the cost associated with registering, right, in all of those states and the applicable fees and the lawyers that do all of that work, that could be almost as much as what it costs to draft the document to begin with. Most franchisors are probably not going to go into all 20 states at the same time. They might start with a small handful. They might start with half, right? But you probably should have some conversations with them about what states you want to go into. If your brand is in one of these states, well, you're going to have to register there, right? Because that's where you're based out of. But that's an additional cost above and beyond just preparing the documents. Now that's just legal, right? In addition to legal, there's some stuff on the finance side, right? You have to prepare some audited financial statements in order to go to market on an annual basis. If you've never franchised your business before, that might be something as simple as an audited balance sheet. But there's going to be some things on the finance side. Then the big ticket item here is just going to market, right? And how do you want to find franchisees? There is a cost associated with acquiring a franchisee. You might have a small handful of people that have already reached out to you and said, if I ever want to franchise the business, if you ever want to franchise the business, I'll be your first in line with a check. Usually once you go through the process of becoming a franchisor, those people run for the hills, right? They got you excited, you got excited, you drafted the documents, now you go back to them and they're like, well, my life has changed. I don't know if that's a good fit. Maybe some of them buy. But after that initial group, right, you're going to have to attract potential franchise candidates, right? You can go through franchise brokers. You can advertise through social media or other digital channels. You can go to trade shows. There's a myriad of ways of doing it, but you're going to need to put together a budget for that, and that budget can't be zero. It's just not worth going to market unless you can get your brand to scale within a certain period of time that's best for the brand. Otherwise, if you don't have that confidence, it's not going to make sense. So sometimes investments into marketing for potential candidates are going to cost you upfront. And if you don't find a franchisee that way, you don't get the money back. Okay. This would be marketing online. This could be marketing at trade shows. This could be marketing in print. There's lots of ways to do it. And you may or may not get leads, and the leads that you get may or may not buy your franchise. There are other types of marketing for prospective franchisees where there might be a success fee if somebody introduces you to that candidate, they go through your sales process and they buy, like a franchise broker, franchise consultants. There are a lot of folks out there that will say, I will provide you great candidates, but if they buy, then I'm going to get a percentage of the franchise fees or a flat fee. And what's nice about that is it's pay for performance, but it may end up being a little bit more expensive than what you could potentially do marketing online. Most brands out there today that want to go to market, want to get some traction, are probably going to do both. They're going to sign up with some broker networks. They're going to do some organic stuff online or pay-per-click or social media. But at the end of the day, look, there is a significant cost to acquiring a franchisee. And when you add it all up at the end of the day, right? Because as they go through your sales process, you may have a discovery day and say, come on in. Well, there's going to be costs associated with that. If you are going to work with some broker networks where most of that compensation is upon a sale, you still have to market yourself. You might have to go to their conferences. There's travel expenses there. At the end of the day, like, I think that you should be thinking that a franchisee, or maybe even better yet, per territory, like that could be as much as anywhere from $10,000 to $30,000 per territory. So if your franchise fee is $30,000 and it's going to cost you $30,000 to acquire a franchisee, which, by the way, I still think is pretty cheap. Because think about it this way: it's a 10-year agreement. Okay, it's a 10-year agreement. So if you paid $30,000 to acquire a quality franchisee that is now going to be with you for 10 years, the math on that is 30,000 divided by 10 years is 3,000 a year, divided by 12 months in a year is $250 a month. If you knew you could get a rock star franchisee and it only costs you $250 a month for 10 years, you would absolutely do that. But up front, if your franchise fee is $30,000 and it costs you $30,000 to get that rock star franchisee, that doesn't leave any capital for the rest of the business to support the franchisee. Okay. So you have to start thinking about this. And even if, you're a franchisor that says, look, in the first year, I just want 2 or 3 franchisees. And in the second year, I just want 3 or 4. Well, maybe franchising is the right play. Because part of wanting to go to market to begin with is so that you can go to market with confidence and you can get traction with confidence and you can build a system and scale that system. If you want to take 10 years to get to 50 franchisees, I'm telling you right now, it's not going to be worth the time to do it. It will be a very painful road. You as a franchisor need to get your business to a level of scale with open franchisees, open territories, open units, open trucks, whatever it is, so that you can then reinvest that money into the system to make it bigger, faster, stronger. and get to that point where the royalties alone cover the expenses of the business.
Jeff, you're spitting out some gold there. These are the conversations that we have with brands all the time, and things that they're not thinking about. And then there's levels to every, like what Jeff just went into. They have follow-up questions. Jeff, Erik, what about this? What about that? I'm here. What do you think about this? And we just go deeper into all of this stuff when we're looking at working with a brand and just helping them. But that was, franchisors, if you only listen to number 8, like that will put you light years ahead of other brands out there. All right, let's go to number 9. Am I ready to lead a franchise brand versus running my own current business? Am I ready to be a franchisor? Because once you go from entrepreneur, business owner of 1 to 10 locations of your own thing to being a franchisor, you go from entrepreneur of, whatever it is that you're a widget that you're selling, a service that you're providing, running your locations, having a district manager, overseeing them, to being a franchisor. Now you're responsible to help other people become entrepreneurs, or entrepreneurs begin to grow and scale their business. You're no longer in the business of whatever it was you were in before. And I think a lot of founders say, yeah, I'm ready for that, but they really don't know what it means. And it can mean hiring a different caliber of person. Like it's C-level talent that you need to hire, probably a lot more expensive than what most entrepreneurs are used to hiring. And you have to give them space to grow, and you have to let them lead the department that they're overseeing, or the authority that you're giving them. And you can't be a micromanager. So there's a lot that goes into this. But number 9, are you ready to lead a franchise brand versus running your current business? Jeff, what would you say?
I'd probably say the answer is no. It is, I don't want to, look, it is what it is. We always say it when we meet with people, like the first rule of franchising is don't franchise your business. And it's a little tongue in cheek, but it's not. There is no amount of guesswork you can do that will ever reach reality of how difficult it is to bring a franchise brand to market, get some traction, scale, and grow it bigger, faster, stronger every day. It is, if you don't have a background in franchising, it is going to be really difficult and very painful. And it will be very rewarding once you get to the other side, but that's going to take many years. Okay? You cannot do this on your own. You can't. Right? It is possible, maybe, but the probability is off the charts that it will be very difficult for you to do it on your own. We recommend having some advisors that have done it before. We recommend building a team that has done it before, that have franchising experience, because it's 2 different businesses. Your existing business might be highly successful, and maybe it's even highly successful in multiple markets, multiple states. But taking that and turning it into a franchise and running and building and scaling it as a franchise, it's 2 different businesses. When you start thinking about the team that you have in place today, you might have an unbelievable support team. And some of those folks probably can work in the franchise system to help support franchisees, especially when it comes to technical knowledge, right? But you're going to need to add people to the franchise team, the franchisor franchise team, that have franchising experience. Franchising experience in marketing, franchise experience in operations, franchise experience in sales, everything, every category. You're going to need to be thinking about adding folks that have been a part of what you're about ready to go through, right? So if you are going to take your brand, you're going to go to market, you're going to be an emerging franchise, you need to make sure that you're building a team that has also been a part of at least one, if not multiple brands that went to market and scaled an emerging brand. so that you can lean on those experiences. You can build out processes and systems that are new for franchisees that you didn't have with the business that wasn't a franchise before you went to market. And so I think that, like, look, there is, and here's the other thing. You're going to need to make key hires ahead of the time of when you need them. If you make your hires when you need them, it's too late, or when you think you need them, right? You can't hire people to plug a hole. You have to hire people ahead of when the hole ever happened. And so that means you're going to need to make investments into a quality team across important pieces of the business, like marketing and operations, at least marketing and operations, even before you have a franchisee. And if you don't have the capital to do that, or you don't have the know-how to do it, then maybe it's too early. And even when you have that initial team, as you start to get some traction, you're going to need to continue to add to that team before you ever need some of these people to be on board. You got to be always hiring 3 months, 6 months, 9 months in advance. And that's going to take a financial commitment from you. And if you don't have it, once again, if you have to wait until you're trying to hire somebody to plug a hole, it's already too late. You got to hire them before the holes happen.
That's why we say, we're franchise guys. We've been doing this for 20 something years. We've been on all sides of franchising. And we always tell entrepreneurs, don't franchise your business. That's like rule number one. Don't franchise your business. And they're blown away. They're like, what do you mean? You guys are franchise guys. We like your model. We like you as a person. We think this can do really well, but you're not ready yet. And we hear that and we get to say that all the time. But what's really frustrating is when we talk to a brand and they are a franchise and they're like, I wish we would have run into you guys, 2 years ago, 3 years ago, because 2 years ago, 3 years ago, we were told this thing's amazing. You're going to be a great founder. You got a great business. They were never told any of the hard stuff about franchising because they were told the dream, like where they can go. And they didn't get advice from the people that were going to be in the trenches along with them. They didn't get advice from franchisors who've been there and done that before. They got advice from someone selling them a service. And so if all you have heard from people that are helping you with your franchise organization get it started, yeah, you should do it. And they're not talking about any of the reality, any of the negatives, trying to talk you out of it to make sure it's right for you. You're probably talking to the wrong people. And what I love is when we're talking to brands and all of a sudden they come around a year or 2 years later and they're doing things the right way. Or when we talk to brands that have had people like us in their ear and they're like, hey, we've taken time and we've done this the right way. We put these things in place. We did this, we fixed that. We implemented these things. Now we are ready to franchise, or now we're ready to scale the brand that we started. And that is a great thing. They listened. Don't franchise your business yet. So, Jeff, anything else before we hit number 10?
Let's hit number 10, man.
All right. Don't do it. Do not franchise your business if you think it is the quick way to wealth. If this is a get rich fast, this is the quick way to build a company, to have a fast exit, don't do it. They've all heard the stories out there of hey, franchising is like software. We can sell this for 20 times earning or 20 times EBITDA. And there are stories of that out there, but they did it the right way. Maybe there's some market timing that came into it. Maybe they had the right territory size. Maybe they came into the market at the right time where their service or product was perfect. Maybe, there's a lot of things that fell into place for that to happen. Maybe private equity was really interested in that in a 2 to 3 year period, or there's certain private equity groups that were really wanting that particular asset, that brand. And that's why things were able to go so high. So there's stories out there. But if you think this is the quick way to have an exit and build a massive nest egg, don't do it, because for every story out there like that, there's a pile that didn't end up like that because they didn't talk to people like us, Jeff. So what would you say to that? Don't do it if they think it's the quick way to wealth.
It's like most things, like building a house, it's like, or most investments that you make, it's always going to take twice as long as you thought, and it's always going to be twice as expensive as you thought. If you have a successful business right now and you want to franchise the business, you want to make sure that your successful business, the way that it is right now, even if it dips a little, what we see a lot of times is folks that have a successful business and go into franchising, the amount of energy that they have to put into the franchise business, we typically see that the founding company that converted into the franchise is going to dip a little bit, because all of their attention used to be here, and now they have to put so much attention towards the franchise piece. We typically see that dip, okay, which is fine. But accounting for that dip, right? Maybe it's even 25%. Accounting for that dip, you need to make sure that you understand that has to feed your livelihood. No matter how many franchises you sell, or no matter how much revenue those early franchisees are doing, you're probably not going to take a single dollar out of that business for 3 years. 2, maybe, but probably at least 3 years, meaning every single dollar that comes through selling franchises or through royalties or through anything else is going to go back into the business to build a leadership team.
So fast. You're scaling so fast.
Yeah.
You need to do that. Like Jeff was talking about earlier, you have hires, you have all these expenses where, you had expenses as a business owner before, but now add a zero or another zero to it. And you're just playing a different game. And so, yeah, I mean, it's I'm sorry, Jeff, I had to interrupt there because we talked to these founders and they think like, I'm going to be $100 million in 3 years. And they are wanting to take out a bunch of money in the meantime. They're robbing their franchisor of money, and they're wanting this massive exit. And they not thinking about it the right way. If they think about it the right way, as invest into the business, that's the right attitude to have. Also, in that first 3 years that Jeff was saying, don't plan on taking any money out. Your franchisors are thinking you're rich. They're thinking that's all you're doing is taking money out of the business because they have this fee and that fee. And so you have your franchisees making you feel like you're wealthy already, or you're just taking all this money out and putting it into your pocket for your lifestyle. You know the reality, but you can't really tell them the reality of it. So you have to fight that as well. So it's not easy. It's not the fast way to wealth all the time. Jeff, keep going. I'm sorry. I totally interrupted you.
Yeah. I mean, I've seen some franchisors that they get a little energy and a little bit of momentum early. And yeah, they think that that's going to continue forever, and maybe it will, and maybe it won't. But they take some of the money out of the business, right? And they think that it's always just going to continue to go up and to the right. And the reality is, once again, like, you're just going to have to reinvest every single dollar. It doesn't mean you don't have cash in the bank. You just got to leave it in the bank. There are going to be times where you need to double down and make some investments. Key hires is going to be a big one, right? That support staff is going to be a big one. But, if you have equipment today that your franchisees use for a product or service, maybe it's the best in the world equipment today, but somebody's out there is making bigger, faster, stronger equipment. The equipment that franchisees buy now, or that you supply them, there's going to need to be upgrades there. There's always going to need to be upgrades on all your web assets, right? Your website, your social media. Like, there's no amount of unforeseen expenses that are going to come your way as you start to scale a franchise. And you're going to need to take every single dollar and keep it in the company, and take money that you kept in the company and reinvest in the company. And you should be prepared that, like, I mean, first of all, the statistics that we always hear is that there's about 4,000 franchise brands out there. And the statistics that I hear is each year about 400 new brands are coming to market. And that's a lot. That means the industry should be growing in terms of an amount of franchisors should be growing by 10% a year. The reality is that 4,000 number of brands hasn't really changed in 5 or 6 years. That means that for every new brand that's coming to market as a franchisor, there's one that was already a franchisor that is leaving. It just didn't work, right? It's this one in, one out. So how do you enter into franchising and mitigate a situation where 3 years from now you don't have to say that it didn't work and you gave it a shot and you have a couple franchisees, but you have to try to unwind it? You get there by constantly reinvesting in people and processes and systems and making your brand bigger, faster, stronger every single day, and reinvesting all of the money for a long while, many years, before you can look at your franchise system and say, okay, now I can take a salary, or now I can take a distribution. This is not a quick thing. You're trying to build a forever brand. And you can't build a forever brand without reinvesting for many, many, many years. If you look at a lot of the deals that happen in private equity today, a lot of those brands have been around for 10 plus years. And they just started getting rosy. The numbers, right? The profitability at the franchisor level just started getting pretty rosy in the last couple of years, even though they've been a franchisor for 10. So it's never going to be as fast as you thought, and it's never going to be the budget that you thought. It's going to be 2 to 3 times more expensive than you thought, and it's going to take 2 to 3 more time, much more time than you thought.
So if we haven't scared you away, we want to talk to you. So reach out to me on social media. Tell me your brand. Go to Front Street EP, Front Street Equity Partners, but it's frontstreetep.com. And fill out that form. And we like to scare people away, because then we're left with the best of the best that start to understand what they might be getting into, because franchising is amazing. We should get into another episode at some point about like what happens when you hit it big. All right, Jeff. Thanks, man. Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.